Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, July 8th, 2026. We're Elena and Marcus.
And today's market is really suffering from a massive case of whiplash.
Correct. Central banks are threatening to hike rates. Capital in the AI sector is fleeing across international borders at lightning speed. And, well, oil tankers are essentially stalled in the water amid rising geopolitical tension.
Right. So we are taking a deep dive into today's data deck to unpack the mechanics of three critical themes driving this session.
Exactly. First, we have a hawkish shock in global interest rates, driven by the Federal Reserve and a severe European repricing.
Understood.
Second, there's a violent momentum unwind and a geographic rotation happening right now in the artificial intelligence and semiconductor space.
Yeah.
And finally, a massive geopolitical catalyst in the energy markets that is fundamentally reshaping commodity prices.
Understood. If you are managing capital or, just trying to understand where the institutional flows are heading right now, you need to look at how these three forces are interacting.
I mean, this is not just a standard trading day. We are observing a structural shift in risk appetite across the board.
Moving to today's data, let us start with the fundamental driver of all this price action, which is the upward shift in the yield curve.
Right.
Looking at our latest run, the short end of the curve is moving aggressively. The two-year Treasury yield jumped 3.3 basis points today.
So that settles at what, 4.205%?
Correct, 4.205%. And further out, the 10-year yield drifted up to 4.571%.
And the primary catalyst for that move domestically is the release of the FOMC minutes.
Right.
When you read through our proprietary updates, it reveals that a few officials actually saw a credible fundamental case for a June rate hike.
Which is a hawkish tilt that really took trading desks by surprise.
Indeed. And that surprise is now being exacerbated by the fact that rising oil prices are reigniting inflation fears.
Because if energy costs go up, the cost of moving goods goes up.
Exactly, which forces central banks to keep rates higher for longer to cool down the economy.
Yeah.
And, this is not just a domestic phenomenon.
Yeah, our daily desk data shows international sovereign debt is reacting just as aggressively.
Right. UK gilts and Italian BTPs are seeing significant yield spikes today.
Dealer desks are now actively pricing in an additional 38 to 40 basis points of tightening from the Bank of England and the European Central Bank by the end of this year.
So we are looking at a synchronized global tightening impulse.
Correct. The European central banks, they cannot afford to diverge too heavily from a hawkish Federal Reserve.
Right, because if they let their rates drop while U.S. rates rise, their currencies weaken against the dollar.
Which just imports more inflation, so they are forced to step up their hawkish rhetoric as well.
Let us apply our first principles rule here and break this down for the listener.
Okay.
If you are sitting there holding a portfolio of high-growth technology equities, you need to understand the mechanics of this yield curve shift. Can you give us a clear, real-world explanation of how this specific rate move actually impacts corporate valuations?
Well, it comes down to gravity.
Gravity.
Yeah. Higher short-term interest rates act exactly like gravity on corporate valuations. To understand why, you have to look at the concept of the risk-free rate.
Okay.
When government bonds, which, carry virtually zero default risk, are paying over 4.2%, investors naturally demand a much higher rate of return to hold volatile assets like corporate equities.
Because if you can get a guaranteed 4.2% return just by holding a short-term treasury, the risk you are taking by holding a volatile tech stock needs to be compensated with a significantly larger potential payoff.
Correct. And that dynamic instantly compresses the multiples that investors are willing to pay for speculative, high-growth companies.
Right.
The valuation of a tech company is largely based on cash flows that are expected years or even decades in the future.
So when the baseline interest rate goes up, the present value of those future dollars goes down.
Exactly. The math fundamentally changes. Furthermore, this upward shift in yields has immediate, tangible consequences for corporate balance sheets right now.
Which brings us to the infrastructure build-out.
Indeed. If you look at our desk data, there has been a massive $90 billion in artificial intelligence data center debt issued recently.
Wow. I mean, that is a huge amount of concentration.
Correct. These companies borrowed heavily to build the physical infrastructure powering AI. As interest rates rise, the fundamental cost to service that debt goes up significantly.
Right. When they go to refinance those loans, the new interest payments will take a much larger bite out of their net income.
Which creates massive performance dispersion across the infrastructure sector.
Moving to today's data on the equity side, That gravitational pull on valuations is painfully visible.
Yeah, it really is.
If you look at the heat map of the major indices today, market breadth is historically poor. Only 22% of the S&P 500 constituents managed to close higher.
Right.
The broader S&P 500 closed down, yet the NASDAQ 100 managed a 0.27% gain.
And that divergence is where the flow data becomes critical to understand.
Okay.
Beneath the surface of the indices, institutional flows show that hedge funds have been aggressive net sellers of single-stock technology names.
Right.
We are tracking a severe 23% drawdown in high beta TMT momentum over recent sessions.
Let us translate that terminology for the listener. High beta simply means these stocks are significantly more volatile than the broader market.
Right.
And TMT stands for technology, media, and telecom. These are the momentum names that institutions crowded into when the AI narrative first took off.
And now that crowded trade is unwinding violently.
Correct. When institutional momentum unwinds, it is rarely orderly. Everyone heads for the same exit at once.
However, that slight outperformance in the NASDAQ that you mentioned earlier is actively masking a massive localized rotation within the artificial intelligence sector itself.
Right.
Capital is not just evaporating, it is moving rapidly across geographic borders.
Indeed. Our daily desk data shows investors aggressively fleeing Korean chip makers today.
Samsung is the epicenter of this move.
Yeah.
The company plunged 7.8% today on an earnings miss.
Which is massive for a company of that size.
Correct. Market expectations for memory demand were elevated, and the physical reality of their quarterly results just failed to meet that institutional consensus.
And because Samsung carries such an enormous weight in the regional indices, that specific sell-off acted as a contagion event.
Right. It dragged SK Hynix down 6.2% in sympathy.
And those combined moves officially pushed the broader KOSPI index into a technical bear market.
Meaning it has declined 20% from its recent highs.
But the capital leaving Korea has to find a home.
Correct.
And our proprietary updates show it rotating directly into Chinese technology equities and specific U.S. hardware infrastructure.
Right. The Hang Seng Tech Index closed up nearly 5% today.
And domestically, we saw Supermicro Computer surge 7.3%, while Arista Networks jumped 8.8%.
The institutional desks are essentially voting with their capital. They are deciding that the hardware side of the equation, the physical servers and the networking equipment moving the data, is a safer bet than the pure-play memory chip manufacturers right now.
On that point, NVIDIA dipped 1% today. But institutional consensus highlights a very different underlying story.
Oh.
Yeah, the company is currently trading near a decade-low forward price-to-earnings multiple of roughly 18.5 times.
That presents a complex valuation debate.
How so?
At 18.5 times forward earnings, the stock is historically cheap relative to its own past performance.
Right.
But in a 4.2% rate environment, investors are forced to ask if that multiple is appropriately discounting the geopolitical and cyclical risks on the horizon.
Understood. And outside of the technology complex, we saw the consumer discretionary sector lag heavily today.
Right. Delta Airlines was hit particularly hard, which ties directly into the fuel cost fears we will discuss in a moment.
Though it is highly notable that specific consumer staples and retail names, particularly Target and Casey's, managed to buck the broader negative trend.
Suggesting investors are hiding out in defensive consumer positions.
Wait, let me stop you right there because I want to critically examine this flow data.
Okay.
I am looking at our latest run of ETF flows, and there appears to be a massive contradiction.
What do you see?
Well, if momentum is unwinding so violently, and hedge funds are actively dumping single-stock technology names, why is our desk data showing robust, sustained institutional demand for broad macro ETFs? Are these funds fleeing the market or not?
That is the exact question dealer desks are trying to answer today, and it requires a critical distinction. We have to separate the concept of degrossing from de-risking.
Okay, explain that.
Degrossing means an institution is abandoning the equity market entirely. They're selling their positions, taking their chips off the table, and moving to cash.
Which is a sign of systemic panic.
Correct. But that is not what our proprietary updates show. Instead, institutions are aggressively de-risking. They are shedding single stock, idiosyncratic, risk-like, holding a highly volatile Korean memory maker, heading into a questionable earnings print in favor of broad index hedges and macro exchange-traded funds.
So they are fundamentally maintaining their exposure to the equity market, but they're utilizing ETFs to drastically lower their specific operational risk in a highly uncertain environment.
Exactly. They want the market beta without the specific company risk.
Moving to today's data in the commodity sector, let us examine the geopolitical catalyst that is driving that uncertainty.
Because it is entirely visible in the energy complex today.
Right. We saw Brent crude spike 4.4% to $79.41 a barrel.
And WTI climbed over 3.5% to $74.76.
The fundamental driver here is a rapid and violent repricing of geopolitical risk.
Correct.
Our daily desk data points to the collapse of the U.S.-Iran ceasefire. And more urgently for the physical oil market, we are tracking active reports of strikes on a Qatari liquefied natural gas tanker.
And as a direct result of that escalation, commercial tanker traffic has effectively halted in the Strait of Hormuz.
We need to explain the mechanics of this bottleneck for you, the listener. The Strait of Hormuz is not just another shipping lane.
No, it is not.
Roughly 20% of total global oil supply transits through that single geographic choke point.
Right.
When military escalation forces commercial insurers and shipping companies to pause operations there, the market is immediately forced to price in a severe physical supply shock.
Because the global economy relies on just-in-time delivery for energy.
Right.
When 20% of that daily supply is suddenly halted in the water, the premium required to secure the remaining available barrels skyrockets instantly.
And that supply shock has an immediate downstream effect on corporate equities here domestically.
How so?
Well, because the flow of raw crude is threatened, the supply of refined petroleum products like gasoline and diesel begins to tighten.
Right.
This dynamic drastically widens what we call crack spreads.
To clarify the mechanics of a crack spread for the listener, it is simply the profit margin a refinery makes. It is the price difference between the cost of the raw, unrefined crude oil they buy and the price of the finished fuel products they sell.
Right.
When international shipping lanes are paralyzed, the fear of a fuel shortage causes the price of finished gasoline to spike even faster than the price of raw crude.
Which directly benefits domestic refiners who already have access to local crude supplies and operational facilities.
Correct. The market recognizes this mechanical advantage instantly.
Yeah, we saw Valero surge 6.3% today, and Marathon Petroleum jumped 5.4%.
Institutions are aggressively bidding up companies that can process and distribute existing domestic supply while the international market is frozen.
On that point, there is a glaring anomaly in today's data run that we need to unpack.
What stands out to you?
With all of this geopolitical fear, military escalation, and inflation anxiety, gold actually fell 0.7% today to $4,077 an ounce.
Right.
In a standard geopolitical crisis, gold is usually the ultimate safe room for capital. It is where investors park their money to ride out the storm.
Yeah.
But today, the safe room is charging rent.
That is a highly accurate way to frame it. The mechanics of yield are overpowering the mechanics of fear today.
Right.
Because those inflation fears drove yields higher across the sovereign bond curve, and because those higher rates kept the U.S. dollar exceptionally strong, non-yielding assets like gold were actively penalized.
Because gold pays no dividend and offers no interest yield.
Correct. The math of holding a zero-yield physical asset in a 4.2% risk-free rate environment simply outweighed the fear generated by the geopolitical headlines.
Right.
Investors looked at the carrying cost of holding gold versus the guaranteed yield of a short-term treasury, and they chose the yield.
Bringing this all together into a broader synthesis, when we look at the macroeconomic triad of today's session-hawkish interest rates, aggressive geographic equity rotation, and a severe geopolitical commodity shock, we are observing the mechanics of a classic stagflationary impulse.
Stagflation being an environment characterized by stagnant economic growth combined with high inflation.
Right.
The simultaneous rise in crude oil and interest rates that we saw today is historically toxic for cyclical sectors and the broader consumer economy.
Because higher oil prices apply upward pressure to input and transportation costs.
Correct. While higher interest rates simultaneously raise the cost of capital and borrowing.
Right.
This dual pressure forces institutional capital into a highly defensive posture.
Which brings us directly to a profound dislocation appearing in our credit desk data today. The credit markets are where you see the truest reflection of institutional fear.
Yeah, what are the spreads showing?
Looking at corporate bonds, high-yield BB spreads are currently trading at historical tights, effectively in the 100th percentile.
Right.
Meanwhile, CCC spreads are normalizing upward.
We need to decode that spread behavior because it tells a very specific story about how institutional money is positioning itself for the future.
Okay.
A spread is simply the extra yield an investor demands to take on the risk of corporate debt over a risk-free government bond. BB debt is the highest quality tier of junk bonds. These are solid companies with somewhat elevated leverage.
Okay, and CCC?
CCC debt, on the other hand, is the lowest, most speculative tier of the market. These are companies that are highly vulnerable to default if the economy slows down.
So, by aggressively buying BB debt, pushing the spreads to historical tights, while simultaneously selling CCC debt and pushing those spreads higher, institutions are executing a massive flight to quality within the credit spectrum itself.
Indeed. They are starved for yield, but they are absolutely refusing to take on default risk in a higher-for-longer rate environment.
Right.
They will take the moderate risk of a BB corporate bond, but they will not touch the existential risk of a CCC company when capital costs are this high.
That structural shift in risk appetite leads directly into the forward-looking institutional themes our desk is monitoring.
Based on the totality of today's proprietary updates, there is a clear institutional pivot occurring. Consider the broader economic regime. We are tracking a structural threat to public permissionless crypto networks as incumbent banks prepare to launch their own private regulatory compliant blockchains.
And we are simultaneously seeing clear exhaustion and momentum unwinding in the speculative AI hardware sector.
Correct.
So the question for you as an investor is this: are we witnessing a durable shift in what the market values?
Based on today's data, smart money may be executing a permanent rotation toward what is termed the Halo Reloaded trade.
HALO stands for heavy assets, low obsolescence.
Right. In a world characterized by sticky inflation, rising geopolitical risks, and high capital costs, institutional capital is seeking safety in the physical world.
So they are actively prioritizing companies with tangible physical infrastructure, hard assets, and reliable near-term earnings.
Exactly. Systematically moving away from speculative technology multiples based on distant future cash flows.
Well, to quickly recap today's session,
Right. Global interest rates are reacting sharply to hawkish Fed minutes and European tightening.
equity markets are suffering a severe momentum unwind that is being disguised by a localized geographic bid for specific AI hardware.
And energy markets are aggressively pricing in active military conflict in the Strait of Hormuz, benefiting domestic refiners while punishing the broader consumer sector.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.